Hi, my name is Aditya. Let's dive into my channel. So let's start with microfinance. So microfinance refers to providing small loans and financial services to low-income individuals who typically do not have access to traditional banking. So the concept became globally famous through Grameen Bank, founded by Muhammad Yunus, who showed that even people without collateral are creditworthy if structured properly. So in India, institutions like Bandhan Bank started as microfinance institutions before becoming full-scale banks. So now, why is microfinance important? So it promotes financial inclusion, it supports small and entrepreneurs, so it boosts rural economic activity to reduce dependency on informal money lenders. But microfinance is not charity; it is structured finance. The institutional access, group lending models, repayment cycles, borrower cash flow patterns, social collateral mechanisms. A real challenge is balancing financial sustainability with social impact. Relationship building and finance. Now let's talk about relationship building. So in lending and fixed income markets, trust is everything. When you deal with MSME, retail borrowers, or high net worth investors, relationship management directly affects creditworthy and business growth. But why it happens? Because numbers don't always tell the full story. The strong relationship between, like you can understand the real cash flows and analysis, and you can identify the early warning signals and improve the client retention, cross-sell financial products. So in microfinance, especially like repayment rates are high not because of legal pressure, but because of community trust and relationship networks. So in corporate finance and bond markets, relationship managers bridge the gap between issuers and investors. So this human layer reduces information asymmetry, a core economic problem in credit markets. Finance is not only about the spreadsheets; it's always understanding people behind the balance sheet. Coming to the credit analysis part, so now comes the backbone credit analysis. Before giving a loan or investing in the bonds, you must say assess risk. Credit analysis focus on answering one question: will the borrower repay? We analyze. Profitability is the business generating through earnings, but the cash flows is their actual liquidity to service debt. Leverage ratios is the debt-to-debt equity interest coverage ratio. Industry risk where is the sector growing or declining. Management quality, governance, and track record. So these are the things. Rating agencies like Crystal and ratings that guide investors. But as finance professionals, we should not blindly depend on ratings. We must also understand the logic behind them. Credit risk is about the profitability of default and losses given default. In simple terms, higher risk equals to higher interest rate demanded. So, in conclusion, so to summarize, the microfinance provide access, relationship building creates trust, credit analysis manages risk. So, together they form the foundation of the sustainable finance. So if you're serious about building a career in banking, NBFCs or fixed income, mastering these three areas is non-negotiable. So this is the thing. So thank you for watching, and I'll see you in the next video. Thank you.